Welcome to the Hughes Optioneering Weekly Workshop, where we scientifically engineer trades for greater profit potential. This is the disclaimer slide. You can pause to read it. We're going to move on. Today we're going to look at AGX, or Argan Inc. AGX is a holding company that provides various services to the power and telecommunications industries through its subsidiaries. Here's the barchart.com tactical opinion rating for AGX. The bar chart rating is an 80% buy with an average short-term outlook on maintaining the current direction. Long-term indicators fully support a continuation of the trend. According to Prime Trade Select rules, the stock is in a bull trend on a monthly basis if the stock price is above the 10-period or 10-month simple moving average. The monthly chart shows that AGX is well above the moving average line, so the monthly trend in AGX is up. Now we're going to look at the daily chart. The stock is in a bull trend on a daily basis if the 50-period or 50-day exponential moving average is above the 100-day exponential moving average. The blue line is the 50-day EMA line, and the green line is the 100-day EMA line. The blue line is above the green line, so the daily trend in AGX is up. Next, we're going to look at a daily chart that displays the Keltner channel. As a rule, we don't want to buy calls if the stock price is above the upper Keltner channel line. Anywhere inside the Keltner channel or even below the Keltner channel is fine. AGX is below the upper Keltner channel line, so AGX is inside the buy zone. Since the trend is up, we want to buy a call. AGX has 4 option chains to choose from. We're going to use the August 15 chain. Right now, the August 15 options have 26 days to expiration. Here's most of the AGX option chain for August 15. AGX closed at 206.63 on Friday. That means any calls on the list from 140 to 200 are in the money. Let's take a look at the profit potential for purchasing the 210 strike call, which is the closest strike to the current price of the stock. The bid-ask spread for the 210 call is 1070 to 1290. Try to enter at the midpoint, so we'll use 1130 as the buy price. Our call option calculator shows the profit potential for this call based on AGX price changes at option expiration from flat to a 12.5% increase in price. We can see that if the AGX stock price is flat at 206.63 at option expiration, the 210 call will lose 100% of its value. Ouch! This is an unacceptable risk. That kind of loss can wipe out a trading account in a hurry. We developed what we call the 1% rule to help us avoid this kind of risk. The 1% rule sets to limit the time value portion of the option we buy to 1% of the stock price. That means the stock only has to move up 1% for the call option we purchase to break even and start profiting. Now let's take a look at buying the 185 strike call to see if it qualifies for the 1% rule. Here's the call option calculator picture for the 85 call. According to the 1% rule, we want to call to at least break even if the stock price is up 1%. The calculator picture shows that if the AGX stock price is up 1%, the 185 call will lose 11.1% of its value. We want that to be break even or better, so the 185 call does not meet our requirements. Let's see if the 160 call will work. The bid-ask spread for the 160 call is 46.30 to 50 even. We try to enter near the midpoint, so we'll use 48.15 as the buy price. The 160 call works. If the AGX stock price is up 1%, the 160 call will make a 1.1% or $55 profit. That's better than break even, so the 160 call is the one we'll buy. The call option purchase calculator also shows that if the AGX stock price increases by 2.5%, the 160 call will make a 7.6% or $365 profit. If the AGX stock price increases by 5%, the 160 call will make an 18.3% or $881 profit. If the AGX stock price increases by 7.5%, the 160 call will make a 29% or $1,198 profit. The plus 10% and plus 12.5% numbers are also displayed. You can see that the profits get better and better. And notice that if the AGX stock price does not make the expected move up and remains flat at expiration, the 160 call would only lose minus 3.2% or minus $152 compared to the minus 100% or minus $1,180 loss for the 210 strike call that we looked at earlier. Now we want to review a call option debit spread, aka a vertical call spread. For this spread, we want to buy to open the AGX August 15 185 strike call and sell to open the AGX August 15 195 strike call. We're going to base our entry prices on the midpoint between the bid and ask prices. That means we'll buy the 185 call for 26.65 and sell the 195 call for 19.90. 26.65 minus 19.90 equals 675. So the entry price or debit cost for the spread is $675. The call option spread analysis calculator picture shows that the spread will make a 48.1% or $325 profit if the AGX stock price declines by 5%, remains flat, or increases in price when the options expire. If AGX is down 7.5% at expiration, the trade will lose minus 9.1% or minus $62. Creating the debit spread will allow us to collect a $1,990 cash credit to our brokerage account for the sale of the 195 strike call. As we said on the previous slide, this reduces the cost of entering the spread to $675. Here's a note regarding earnings reports. The next AGX earnings report is scheduled for September 3rd. Let's review the trades one more time. The first trade was a call purchase. It said to buy to open the AGX August 15 160 strike call for 48.15. We also reviewed the spread. The spread said to buy to open the AGX August 15 185 strike call and sell to open the August 15 195 strike call at a debit of $675. That's it for this week's Optioneering Workshop. Thank you for joining us. We look forward to seeing you again next week. Where are you?